Good day, folks. As we move forward, we're going to get into the analysis process now that we have a background in place. I'm going to go through it step by step so that we have a logical model to follow. So the first three steps is to import your detailed 10K and Excel into Excel and develop some base financials. So what we want to do is import 5 years of income statement, balance sheet, and cash flow into an Excel worksheet. Then we're going to create summary financials and then create common size financials. Now, for those of you that have taken 311 with me, you should already be familiar with this process. If you haven't, you need to get up to speed. All of the analysis work is done in Excel. The starting point is that financial information in either the 10K or the 10Q. You can extract either data from either the company website, Edgar, or Bloomberg. It is up to you. Bring all the data into your Excel file. Label a worksheet 10K data. Build everything for analysis from this worksheet. Reference and formulas. You don't want to input numbers as you work your way through this. The first thing is that, and why we got to start here, is that a 10K has so much information, it's hard to know where to start. Okay, so a starting point is needed, and then you work your way down or peel back the onion. So it's really that macro level of data can help us better focus on where we should be looking. So we're going to import the details. This is step one. We're going to start with the income statement. Not every line is needed. You need to make a determination of what is important. So you're going to create a summary income statement. So you're going to look at the income statement and say, what's material and how should I look at it? Okay, so let's start. We're going to start with the income statement. And you're going to take a look at it. And you're going to say, yeah, there's all this stuff in it. Let's narrow it down to what is really important when we create a summary income statement. You need to make a determination of what's important. Okay? And we want to look at it on a 5-year basis and often look at it graphically, as sometimes the graphs can give us a better picture. So here's an example of the balance sheet of Steel Dynamics, which by now you have come to love and enjoy, is that I'm looking at it and saying, wait a minute, what's really, really important here? So what I did is summarized it. I don't need, if you see two lines for sales, related and unrelated parties, when I go back over here, I only show one. So what I've done, notice I've gone from oldest to newest, and that is going to enable me to draw a better trend line, understand trends, and also as we move forward to forecasting and valuation. So that's the first thing. So I have summarized this, and this is a summary. A summary means it doesn't have everything in it that the face of the income statement does. So when we're organizing it, you want to make sure you're using appropriately rounding. You don't need all of these decimal places. You don't need all of the zeros. And it should be consistent throughout your document. Decimal points, either in whole percentage or no more than 2 decimals, if it's material, if it's telling us something. We don't need to go out 5 decimal points if it isn't telling us anything. So rounding becomes important. Use whole numbers, no zeros. For the most part, that isn't going to add anything to our analytics. If the 10K number shows it with 000, eliminate that when building your models. The more zeros you have out there, it just gets confusing, to be honest. You start the dollar at the start of a data range and at a final sum. Not every line. Underscore, single after any sub, double underscore to final summation. labeled clearly. And as I said, data should move from right to left, starting with oldest to most current. Why am I talking about some of these basics is because we're talking about being able to understand numbers and communicate what's happening. And sometimes the simpler we make them, it's much easier to pick up on changes in trends. The next thing I want to talk about is common size income statements. And common size income statements display data not as a dollar amount, but as percentages of total revenues, sales. So sales is always, revenue is always 100%. Okay? Everything is based off of that. Every expense item is shown relative to sales. Well, that's important for that has two benefits. One is that we'll be able to see important trends which may not be seen in raw dollar amounts. It's the relationship. Will also enable us to compare firms of different sizes so that we can see what that relationship is between cost and revenue, profit and revenue. And if you look right here, I have put this piece in for you. You can click and find this. Financial statement analysis, common size ratios. That is for the FAR CPA in FAR, and it helps us understand a trend. And here's an example of what I have put together for STLD, but I can see the relationship between the different line items and sales. Even if we go back, we got all these raw numbers, we know it's getting better, but we don't know what all of these in the relationships are. So that's why we want to use a common size. Once we've laid out our primary financial statements in our Excel workbook, we're going to have, that's going to be labeled one worksheet, 10K data. Then you're going to have another worksheet that would have income statement, another one with balance sheet, and another with cash flow statement. Once we have the basic data, we've summarized it into its pieces, we're now going to start the analysis process. The first one is foundational. Okay? What is happening? This is the most important part. If you don't understand what's happening with revenue, same thing with when we're trying to find out what the volume drivers are, what is it that they make, produce, sell. Normalized expenses are best seen in relation to revenues. And many performance indicators are based on revenue. So revenue is needed to understand our cash flow and capital budgeting, what we have. So this becomes a critical step in our analysis process. There are two basic techniques that we could use, and the first one is a 5-year period, oldest to newest. You start with the tabular, just a form. What is the trend? Then you convert it to a growth rate. And what we tend to do is compute, so start with the tabular, put all the information in, okay? And then compute the annual and 5-year average growth rate. So we're looking at sales trend in dollars, then we're looking at growth rates, and displayed visually as a graph. Then what we can do is explain period to period changes by using the volume and rate drivers. So not only do we see what the trend is, we can explain it relative to those volume and rate drivers. Okay? Oftentimes, companies will go through mergers and acquisitions. So what we have is revenue growth happens, and sometimes it looks spectacular, but it's a result of a merger or acquisition or other affiliation. So I think we want to always take a look as if a company has been successful in acquiring companies. It may look like the revenue is growing very rapidly, but it's growing as a function of its acquisition. So we want to distinguish in those cases between organic growth, growth that came from within the firm, versus those that are acquisition related. And we may either want to adjust our financials to show that so that we have a continuous picture that isn't impacted by the acquisition itself. Here is an example of what I did here for Steel Dynamics. The first thing I have up here is I have created a graph, and what I have shown in that is, first, this is the sales amount, and then what we're doing is looking at the annual growth, which is in percent, and then we're looking at the growth rate, the cumulative growth rate. So that's very easy to see that it's getting better. It seems to flat. What I was able to do with Steel Dynamics was to break it down into different segments. So this is the business segment: steel operations, metal recycling, steel fab, and other, for a total. So what I've done is indicated the change in segment, how people look at the company, how does the company manage. And I saw the absolute dollar percentage, dollar change and percentage, 16, 17 to 18. So when I look at this, let's just take steel ops for an example. Went from 7,175,000 to 9,263,000. So it went up by 29%, $2 billion. So when we're looking at this from an analytical point of view, we want to know, well, why did it go up? This just tells us it went up and how much it was by business segment. What we really want to do is to be able to understand what happened with sales. And I did a couple of things here. First thing, this is the top level that you just saw. What I then did is broke the driver up. Okay, and in this case, since it's steel, its weight, the volume is in millions of tons. Okay, and within the 10K, I found the shipments and average selling price chart. So it says right here the shipments were $997. There we go, $997, and the price per ton for the year was $922. So now we know what changed. So we know that of this $2 billion here, there was a 648 million ton increase in output, the volume indicator, and the price went per ton, the rate went from 767 to 952. So what I was able to do was to calculate the change in sales volume of this 2 million, how much was related to volume and how much was attributable to rate. And that gives me the total change explained when I do the calculation of 2,046,000, which is reasonably close. Okay. When we open up our worksheet, Steel Dynamics, this is the income statement. If you go back over and look, we got the 10K data, income statement, and I added the sales analysis in here. So when I look at it on a Excel basis, you can see that I have these columns, and all of them are referenced back to the 10K. I compute the difference between them, and then the annual growth and a 5-year growth. And I did put this on you can see here, I put it on a trend. Now, I've been working with STLD for a couple years, so I just updated it for 2019. So I actually have a little more than 5 years. But then what I did is I took a look here at the difference between what is happening. Let me just highlight this for you. Is if I'm comparing 2018 to 2019, 2019, I can see the change here in the business segment, and I calculate the percent. Now again, these are all so what you do is, once you have this, I know where the change is. So the question is, what happened in steel operations? Because this year, from 17 to 18, we saw an increase of $2 billion. Now it's a decrease of $1 billion when we go to 2019. 2019. So we want to take a look and say, well, what's causing that? Was it that they sold more volume, or was it less volume, or was it less on the price? So what I did is, if you're looking at 17, what I did is I found out, I knew the set dollars, and I went to the 10K, and when I was in the 10K, I found that, and if you just give me a second, what I found here in the 10K was information that told me what the shipments were and the average sales price. So once I knew the actual volume, the measurement, what did they sell, I was able to identify in each of these years that the tons, if I look, tons went from 93.49 up to 99.87, down 156 to 98.41. So I know what my volume is. I knew what the price was, and I could. So once I have that, I knew that there was $1.28 billion less in revenue caused by 156 million tons less of production, and I sold it for 87. So now I want to find out what is the change. What is the change in of sales? This number right here, this $1 billion number. How can I break it down? So what I did is computed how much is attributable to volume. So what I did is took the change in volume right here times the price last year. Okay, because that went away. So 143 million was the result of selling 156 million tons less. I then took the rate dropped by 87. So what I did is take our 45, which is the current year's number of 10 tons, and I multiplied it. So what I was able to do was account for, if I were to explain why sales declined from $1.28 billion, I would then say that it's attributable to a reduction in volume produced by 143 million. Price came down, and the decline in sales price, caused 856. And together, that's the $1 billion. I proceeded to do that for every segment, but the question then becomes, what was it that caused those things to happen? And that's what, if I go back to what happened in the prior year, we took a look right here. Strong domestic demand, especially automotive, construction, and energy, drove import demand. Lower imports drove demand volume because the price was the same. The rate increased as a result of strong demand, higher tariffs on imported steel, and increase in value-added products. They changed that mix. So, and it went down, okay? The price went down as the demand went down. Okay, so this is the very important thing, is once we understand this, we can then move on to look at all the other costs. So that's a quick look at sales analysis. Stay tuned for part 2, where we look at some of the accounting issues around